Hello, welcome back guys. So in this video we're going to talk about a company that I currently own. I own stock of it. It's Carnival Corp, and I have talked about it in the past and the reasons why I bought it. In this video we're gonna do a little bit of a summary. Talk a little bit about what has been happening with Carnival, whether it's an interesting opportunity right now, what are the financials telling us about the company, and what is the potential reasoning of adding this to portfolio and the risks of it as well. Now, before I actually delve into the financials, let's take a look at the stock news module. And remember, all of our patrons have access to everything that you're seeing here, the tool, and you can become a patron by visiting myinvestorshaven.com or basically visiting the links in the description box below this video. Now, you will see here a lot of positive reactions, a lot of positive news, and this is nice because you have a very nice summary here, which you can very quickly look into and see what is going on in terms of sentiment with the company, like options action. Traders looking bullish on Carnival Cruise. Carnival shares rise after 2 analyst upgrades. Why Carnival, Norwegian Cruise Line, and Virgin Galactic stocks all popped on Monday. JP Morgan upgrades Carnival. So all of these things are pointing to a more bullish action. And you can kind of see it here in the metrics page of our tool, where the stock was actually up about 13%, 12.5 yesterday and 3 today pre-market, so approaching 15.20 right now. And if you take it back to 5 years, you can kind of see where the stock was. The stock was like near $70, and you can kind of see it here in all our charts that it has been completely destroyed, currently sitting at 14 to 15, as we said earlier. Now, when I bought this one, I did buy it basically in the pandemic years, and my reasoning for this is to basically add it like a swing trade. Now, the important thing to understand is that this is not so much a financials play. It's not a play that has a lot to do with the finances of the company, although they do matter, and the previous financials, like the years before, do matter. But the main reason why I bought this one was basically like a play for the pandemic. So it was like a consumer cyclical play. So the idea behind this is that you get cycles in the economy. You get cycles, and you can have a ton of different cycles. We have seen an oil cycle, for example, where a lot of companies went bankrupt, and then there was a boom. And the same thing kind of happening with companies of that sort, like cruises, and could happen also with airlines and companies of that sort. And so I wanted to potentially capitalize a little bit on the potential opportunity, recognizing the risk as well, because these kinds of plays do not come without risk. A company of this sort, if it stays stagnant for a long time, and if they keep getting extra debt and they cannot actually service their customers and they keep losing money, they can even go bankrupt. It's possible, it's a possibility. And you should understand that as a potential swing trade investor in this case. Now, if you're willing to take a little bit of a risk and add a little bit of money, as I did, like I added about $3,000, I believe, very little money actually compared to what I usually have in other stocks, because again, this is a risky play that I recognize, but it has an upside, and the potential upside could easily be something near the 40s, for example, like reaching this previous level when things actually get back to normalcy for the company. You can kind of see here that all of the ratings here have been completely devastated because they have been losing money. But if you take it to the previous years, they were sitting at about 14, 10, and that's normal, that's kind of normal. And they were sitting at this price range. So the play for this one is to potentially see an uprise, an eventual uprise, where the company actually goes back to its previous levels and doesn't even increase from there. So I could potentially see myself selling at 50, for example, when it reaches that level. So when it reaches around these levels, I could potentially see myself selling. There's going to be a lot of selling near these levels because there are a lot of backholders near these levels, as you can see here. So a lot of people are going to be wanting to break even pretty much and induce some selling pressure here. So you may want to sell maybe somewhere around 45, for example, in some situations, if that happens, of course, right? But that's important to understand what is going on here, and you can kind of see it in everywhere in all of these metrics here. And the company has been issuing tons of shares because, again, obviously they have been losing money, and that's the bad thing about it. They have been losing money. They have to be getting extra funds. They have to be getting extra debt, and you can kind of see it in all of their metrics here that are negative. So again, it is a company that has a lot of risk, and so for anybody who invests in this one, you never go size. Like going size here is killer. You don't want to buy too much. You want to buy just a little bit with the potential of even losing money. I did the same thing with another company, another well-known company that I've talked about in previous videos that I made, and that's basically US Steel, United Steel Corporation. I kind of want to show you what happened here, because this is a trade that was pretty lucrative for me. because you take a look at this at this chart. I think I bought it near 2020 when it was like near 8 or something, and then I sold as it was rising and rising. I think more than 25, something of that sort, and it actually went even higher. And this is what I like to do with companies of this sort. And this is basically X, for example, like United Steel, is a nice idea behind that, a nice opportunity, a nice case, I should say, a nice potential case for doing something of that sort. You can kind of see through the years where the company has been sitting, like many 40s, many near 40s over here, then going back down to 10, then going back down to even 7 here. So what I do like to do with these kinds of super cyclical companies is buy them where they are super low and then just forget about them. And just have some size that I'm confident with, and even if the company goes bankrupt, in the case it goes bankrupt, it's not going to hurt me. So that's what I'm doing with these kinds of trades. So am I buying United States Steel Corporation today? Hell no. And I don't even care if it's going to reach 40. It's just not the play for me. I wanted to go near 8, for example, or $7. This is when I will be entering the stock for sure. And when I did that, for instance, last time, I like almost quadrupled my money. So it went really well. Okay, so let's go back to CCL, that's Carnival Cruise, and see what is happening with this one. Oops, I think I clicked the wrong one. Let me fix it. Yeah, accidentally clicked the London one. Okay, so let's take a look at the financial statements, because you will see the story of the company through the pandemic years as well. Like at some point they were doing 18, 20, then 5, then 1.9, and now back to 12. So it looks like we're going back to almost normalcy. This is exactly what I like to see. Now, obviously, the company has been hurt a ton. Like they were making money and then they were losing tons of money. Look at this, like they were losing tons of money, 10 billion, 9 billion, then 6 billion. So they are still losing money, and it's something that you have to recognize as a potential swing trader here. And also the same thing happened with the debt. Like look, take a look at this long-term debt. They kept accruing more and more debt. Again, understandable. Again, this is why you should be always fearful of a potential even default for companies that are not able to go back to their previous state. And this happens a lot. So you have to recognize that this can happen, and you have, if you are entering such a company, it is a risk that you are willing to take, and you know that you could even lose the whole lot, the whole investment here. With and the potential is a return of maybe 3 times or 4 times. So it's a risk that you either take or don't take, but you never really want to go size. And the total equity again going down because of too many liabilities, a lot of debt, and again the company has been losing tons of money, and this is almost resetting here. Same thing with the cash flow statement, and you will see that the company has been losing net income here and operating cash flow. Same thing with the free cash flow going down and down and down from the previous positive years. We're getting to negative territory, and again this is what you are buying this for, a potential reversal, with the understanding that there is some risk is the case. Now, because we understand all this right now and we know what is going on with the company and what to expect from it and what the risks are, we take a look at the financials in the previous periods, like 2018 and 2019 were the normal years, and these were the outliers, including 2022, because you will see there was a massive decline here in revenue, and then there was a massive increase. And this brings the 5-year average to 83% in terms of revenue growth, because it's skewed upwards because of this value. The thing is, you want to take a look at the previous year and see that the company was doing like 7%, 10% over here, and the net income margins were near 15%. And this is exactly what we want to be trying here in our projections. We want to be near these values, the normalcy pretty much. We don't want to overdo it. We don't want to overcompensate for what has been happening in the past. So I'm going to go 7, 8, and 9, basically following what the revenue growth has been in the previous years where the pandemic wasn't there. And the net income margins that I'm going to be using is 14, 15, and 16. Again, what the company has been usually doing. And I don't want to be using these negative years because obviously the company has been affected by what has been happening, and you are going to be getting a very, very skewed picture. And again, that's the whole point of buying such a stock. You want them to return to normalcy, and this is what you are accounting for, with the anticipation of potentially having to wait a little bit, and the risk also that I mentioned earlier. And the free cash flow margin that I'm going to be using is going to be something like, let's say, 70, 80, and 90%, and 13% for the annual return. Let's see what we're getting here, just to give us a little bit of an idea. I'm getting a 17, a 21, and a 27, which I think makes sense with the previous values. it makes a ton of sense to be buying a company at these levels. Even 27 here is still a price to pay that is fair, and currently sitting at about 15. And so this is why I would be potentially considering to add this one even at these levels. And I do hold it right now, as I said. And I do think that, again, it's an opportunity with a ton of risk. And I want to make this clear. There is risk. The company could still go down. I mean, even if we returned, from the pandemic years, there is risk, elevated risk from what has been happening in the past few years, just because there is less credit available, there's much debt. So, it's going to be risky for the company. But again, if somebody recognizes that, it is a potential for maybe 2xing or 3xing or 4xing or even more your money, because it has been starting from about the 50s, 60s in the previous normal years. Again, not saying that this will happen. I have explained. Again, be careful about these ones. They could go down. So understand that you could be losing everything if you invest in this one. And it's only for sort of like the risk, the people who don't really care about risk so much in some situations. And I do care a lot about risk, so my normal investments wouldn't be these things. But once in a while, I have a little bit of a small part of my portfolio where I try these kinds of swing trades with, and I allocate maybe something like 10,000 or something of that sort for such plays. But my normal stocks, my normal plays are not these, and this is not a long-term hold from a long-term portfolio perspective. Again, I want to make sure that this is understandable. Thanks for watching, guys, and I'll see you in the next video. Bye-bye.